Thank you, Chris. That's quite an introduction. First of all, I'd just like to say it's great to be back in Mumbai. We were here last week, and we've spent the weekend with our clients, friends, and partners across India. So I'd particularly like to thank Mr. Sahu and Ashish and Viraj Kulkarni here from Pivot for joining us at that event, where this was also a great topic of discussion. I'd like to thank the BSE for hosting us here, and also like to thank Sanjeev Kaushik for attending today, and Professor Ajay Shah. Also at the end of the panel here we have Anish Kumar, our country head for India. Anish will be talking in a few minutes as well. So I think, as we've heard, India's capital markets have done so much in the last 20 years or so. Now, depository receipts here in India are viewed purely as one thing so far, as a capital raising instrument. So since BNY Mellon assisted Reliance Industries back in 92-93, that's the way that India views the depository receipt. It's great also here today to see that we have some of our clients and friends in the audience as well. So thank you very much for you all coming along. Now, DRs are just much more than just a capital raising instrument, either used for listing, as Chris mentioned, by the likes of Alibaba and others in the US, or in an Indian context, Dr. Reddy's, Infosys, Wipro, HDFC, and others, or to raise capital in London or Luxembourg, and we have the LSE here today as well. Welcome, Ibikin. Companies in London and Luxembourg, for example, like State Bank of India, Reliance, and others who are listed there. Now, as I say, the DR is much more than that. It's effectively also an access product. So what we refer to in the industry as level 1 depository receipts, or effectively OTC non-capital raising depository receipts, are what's recommended by the very progressive Sahu committee report. So although you could argue in an Indian context, DRs may not be so relevant as they once were, actually we argue the opposite. We think they're more relevant now than ever. Effectively, Indian companies can access additional investment through this non-capital raising DR. As Sanjeev mentioned earlier, there is also the QFI route and FII investment route. And these are all obviously also progressive developments in this market. What we're discussing here is additional incremental investment for investors who may not be able to access this market in that way. And I think, as Mr. Sahu said, this is all about home market bias, where investors want to invest in a security, often in their own market, for US investors in US dollars, and accessible in the same account that they hold their normal equities. So Chris was talking about earlier, there are over 3,700 DR programs globally. More than 4,500 institutions globally invest in the DR product. And the total market capitalization of the DR industry is around about $800 billion. As we've been talking about this for several years in India, we were often told, or the remarks that we would hear is that investors who want to come here and invest will do it anyway. And that's true. Fidelity, BlackRock, Lazard, and others, Templeton, will all come here through the FII route and invest directly in India. We know from speaking to investors on a regular basis that investors are looking for additional access to Indian equity, not through those routes. So these are a specific type of investor who prefer actually not to come here directly for various reasons, or prefer not to use ODIs like P-notes and ETFs, for example. So what we did, we looked at public filings, and we looked at investors who invest in depository receipts. And what we found through these public filings is that 50% of the investors who are investing in Indian companies through DRs are not investing in India directly through FII route. So again, that's 50% of those who are investing in the limited number of DRs are simply not coming here. So we produced a paper rather grandly entitled India Easing Conditions for Investors, which created quite a lot of interest. Now, what types of investors are these who want to invest through a level 1 ADR? Quite often they're what in the US is referred to as separately managed investors. These are high net worth individuals who may be investing through an SMA account with the likes of Lazard, Fidelity, and others. So although these institutions are coming directly to India and investing in Indian ordinary equity, their SMA portfolio is unable to because those portfolios need a US dollar denominated security. So what happens to these funds is effectively they end up with a divergent portfolio performance where the institutional portfolios bring in one rate of return and the retail portfolio is bringing in another, which clearly could cause some compliance issues. Now, non-capital raising OTC DRs are not just about the US OTC markets, and hopefully after this session you have a chance to meet with Jason Paltrowitz here in the audience, who is responsible for the US OTC markets. Now, OTC means something quite different in an Indian context or a global context to that of what it does in the US. The OTC markets in the US are US, SEC, and FINRA regulated. And over 2,700 ADRs trade on that platform. So I hope you get the chance to speak to Jason. I should also mention the London Stock Exchange. London Stock Exchange has what they call an ATT platform, which is simply admitted to trading. So again, that's like testing the waters. If you don't want to go for a full London Stock Exchange listing, the ATT route is available, and some of BNY Mellon's clients from other countries have undertaken that route, and Ibikin and Marcello here can give you some indication of how that might work. So, I'm probably taking up too much time already. So global investors are welcoming this. Okay, there are 1,500 plus FIIs investing directly in India, but there's another opportunity out there. So the benefits to investors, they can buy in their local time zone. It's cost effective, they don't need to set up accounts. And think about these investors, they're not just investing in India, but they're investing in markets globally. So rather than go and set up accounts in each individual market, that's why they want to access the GDR or the ADR. What are the benefits for the issuers then? So that we've heard a bit about investors already. The benefits of the issuers are that it's access to new investors, to incremental investment. It gives them new visibility in another market. There's really no cost or very low cost in establishing this. We're not talking about full stock exchange listings here when we talk about the OTC products. No additional disclosure required for the level 1 in the US OTC markets. And then companies also get access to investor relations and corporate governance support from depository banks overseas. Each year we produce an investor relations survey, and we do an India breakout. So we have a whole number of Indian companies who complete this survey. Just last year we found that 92% of those surveyed suggested that the US market was the #1 market that they were looking for additional investment, followed very closely by the UK and by Singapore. I'm mindful of my audience here as well, of course. What's in it for the brokers here in India? So these programs effectively, the DR program starts off with a zero balance. There'll be no DRs outstanding when it's established. No new money and no new capital being raised, therefore no new shares being issued. For each ADR that gets issued into a new program, there needs to be a trade here on the BSE to facilitate that. So effectively, just briefly and bear with me here, if we have a US investor who wants to buy TCS, currently TCS has no DR program. That investor will go to Charles Schwab, and assuming these regulations come into force, Schwab will either buy that on the US markets, or assuming there's no DRs outstanding there, will come to a broker here in Mumbai and look to purchase those ordinary shares, deliver them to a depository bank, who will then issue the ADR. So there's also been a fear when we've spoken to people in India in particular, that there's an offshoring of the market. Now, I think if you hadn't had a chance yet to read the Sahu Committee report, page 42-43 deals quite directly with that. Instead of the market being offshored, there's academic evidence to suggest that actually the pie gets bigger for everyone. You actually increase the trading not only here, but overseas. And I should compliment Ashish, actually. When we met almost 2 years ago, Ashish got this right from the get-go. So thanks, Ashish. So in summary, we want to compliment the committee on such a groundbreaking, progressive report. Global investors have welcomed this report. Towards the end of September, BNY Mellon will be hosting an investor roadshow in New York, which will include Ministry of Finance, Mr. Sahu, and others. So I think that will be a great opportunity to hear firsthand from investors on how they feel about these liberal moves in India. So we complement the ADR GDR scheme. We also complement the Bharat DRs and IDR scheme, which is coming out as well. In 2010, BNY Mellon supported Standard Chartered as a structural advisor when they listed here in Mumbai. I hope that this new scheme will see other corporates also come here and give the opportunity for employees of overseas companies operating in India, but also for the Indian people to invest in stocks locally, where there's also a home market bias. Thank you very much.
I'm coming in last, so I'll be brief as well because I'm cognizant of the fact that the Visarjan is also on. Thank you, BSE Bank of New York, for this wonderful opportunity, and Ashish for sharing the thought that I started my career at the BSE, and in fact was appointed by Mr. M.R. Maya, whom we lost last week. And it's always homecoming, but it's also there is so much more to learn from forums as these. Today I thought I'll just share a few thoughts on what I felt about the new DR regulations, as well as the practicalness of it, as well as the FPI. In my view, these are the two major and significant developments in our capital market, and I say this from my years of experience of working in this market and working across international markets and meeting with investors overseas. The FPI, as we know as the Foreign Portfolio Investor Scheme, is an amazing piece of work because year on year for almost 10 to 15 years, we went around telling India is safe, India is risk, and the correcting or improving the investors' perception, inviting them to come to this market. And at one stroke, this particular regulation not only made the market, our market, actually as competitive as global market, it made it easier. And more importantly, the harmonization of the regulations actually made it much more convenient to interpret and sell or position the country. In this process, even the KYC regulations got improved. And today there is a sort of celebration, and if you look at the country's progress on the number of FIs and sub-accounts, we have about 8,500 FIs and sub-accounts which have come into the market, and maybe over the last 20 years, only about 40 or 50 may have exited the country. So that sees that one is, in spite of being seen a difficult country to enter because of the regulations and the way of operational processes, there were 8,000 odd institutions which came to this market. Now, what's the big change in FPI? The big change is primarily that we are now allowing the non-broad-based funds to come into the market. And just from my experience of having worked out of in Switzerland, Mr. Kaushik, let me share this. FPI, you can safely expect $3 to $5 billion coming on an annuity basis into this country from a new segment which is not broad-based and which is also, as Neil mentioned, from a segment which is SME in the wealth management segment. Besides the opportunity, I guess what we need to do with regard to the FPI is our strategy as a country, as a player or an intermediary, has to change significantly from the way that we have been positioning the country. India can no longer be marketed to this segment as what we have done for the FII. There is a very different ballgame which we have to use, and that primarily starts with investor education, because this segment, which is the SME segment or the wealth management segment, etc., does not visualize India the way the foreign institutional investors have seen, discovered, and dealt or understood and succeeded. Once again, is an opportunity for us to position the depth of or diversity of our stock exchanges, the resilience of our clearing corporations, and the protection which is offered as a segregated account as a depository. I mean, it may be a surprise for most of you to know that probably the second and the fifth largest depository of the world is in this country, and the speed of the exchanges is just unparalleled. And from a T+ index market to a T+2, this country has really done it much faster than other jurisdictions. So I think the key requirement is to take the pieces that we have got together, which is the strengths of the exchanges, strengths of the clearinghouse and the depository, package it and do an investor education to this segment, which is housed in particular territories of the world, and go there. Because this money, once it comes in, it stays. Unlike, let's say, a hedge fund, which may move in and out, this naturally stays. So, frankly, my belief is $3 to $5 billion is not a big deal, to bring into this country through this route. I see a great opportunity for Indian custodians, Indian brokers as well, because this segment will look for people who understand this market, who understand speed, who have dealt with retail, and this is a great opportunity, I would say, to a lot of custodians who could not earlier participate very actively into the FIR segment. The other big development is the SAU committee report. Whenever, every speaker has spoken about it, every forum that I've been attending has only mentioned, what is positive. And frankly, when you read that huge report, you just get excited about, how attractive this country is getting and becoming more competitive. And in a large sense, the committee really deserves all the kudos, because this committee's report, I've been told by some of the other people in other markets, they're reading it to improve their markets. This is just to give you a sense how much work has gone into it. Now, the developments in the DR, in my opinion, will be complementary to the developments on the FPI market. So FPI basically, and why do I say that? Because if one of the key aspects covered in this particular report is the enabling of level 1 issuances. And level 1 issuances will create a visibility about Indian securities which earlier did not exist. So when you trade more often, list or more often overseas, the visibility that is offered to the Indian securities becomes much more than what you see now. And if one thinks that, yes, is it shifting our markets overseas? Frankly, if you look around the world, and Neil, I think you may agree with this, that the level 1 does not mean that your markets shift out. It creates so much visibility that most of the trading still goes into the home country. So effectively, I think this is a great tool. We earlier talked about P-notes, but now we have a better stuff, which is basically the level 1 issuances. And once this visibility is created about Indian securities, what it does is it also enables the investors to feel confident about the country, feel confident about our systems, and enables all of us who used to go and present the country to sell it much more effectively. So that builds faith and about a country and its stocks which are listed and improves the inflow. So I would not again here be out of place in mentioning that whereas the top FIs look at the 40-odd companies for investment, the potential to go to 60 or 65 in the next 2 to 3 years is very strong, which basically leads to more capital formation or more liquidity. So to me, these two are very exciting sort of developments in the last 1 year. There are many more that has happened, the FDI recommendations, and so many are out there. But coming on to, again, the SAU committee report, I think a need, in my opinion, is also to see that it is operationalized soon, because one of the things that we really do very well and exceedingly well is we come out with fantastic policies. And in fact, I would say that in the case of the FPI regulations, SEBI came out with FAQs for investors, enabling them to understand. So while we are great at coming out with policy, I think the time lag between the recommendations and the operationalization is something that is quite significant, and that sort of wanes in investor interest, because whenever a policy is announced, everybody is out there wanting to know more and when is it coming and happening. But in fairness, in spite of the multiple regulators or even the SROs, in the last 2 years, the implementation of some of these policies have crunched to about 6 months gap between the announcement of the policies and the operation. I think the moment we get the operational aspects out, we can see a great development on even the FPI, in the FPI regime. So once again, congratulations, Mr. Sahu and the team, and for just putting and making India more attractive. Thank you.
The last man standing for the day. Oh, we're a little ahead of schedule, I guess. Viraj cut short his speech by 2 minutes. I think no event of this kind or a seminar of this kind can end without a Q&A session. Let me also assure you that most of the speakers here have condensed their speech into the 10-15 minutes capsule that they were provided. You should ask them the questions to get something out of the profound knowledge they carry on each of the subjects. Let me also tell you that I was fairly thrilled to see so many of you in the crowd. And it's such a daunting day with Visajan happening. I'm sure all of you would have at one point in time thought that how would we even get there or get back home? But I'm told the traffic is easy today. Well, to that extent, I must also say that this is one of the most comprehensive and diverse views that I've seen or heard on DRs ever since the new report came into being. So I'm sure there are a lot of questions in your mind. I would open the Q&A session, but for those of you who want to ask the questions, you may raise your hand, and I'll arrange the mic to migrate in your direction. Please state your name and the company that you belong to, and if you have a specific question to any of your panel members here, please also tell their names. So, Q&A time. Who's going to raise the hand first? Okay, there you go.
Thank you very much, Anish. Ibukunadi Bayo from London Stock Exchange. Great panel. Thank you very much for the insights that the panel has shared. I have a very, very simple and very specific question with regards to the notification of the SAHU committee recommendations, and specifically on the issue of tax. Is the panel able to tell us the very specific nature of the tax issue that is outstanding that requires clarification? Thank you.
For want of time, I had skipped this slide. So essentially, the idea is that the tax regime should be as neutral as possible. So there are these 6 or 7 events or activities in the process of issue, trading, transfer of either BHDRs or ADRs. The first event, let's say the issue of a securities by a overseas firm to an Indian depository in BHDR. We always look at tax when there is some income, some profit, some gain. This activity, issue of a securities to a depository, does not give any kind of income or profits. Similarly, we are contemplating the deposit of permissible securities by the holders of those securities with a foreign depository. That means unsponsored issue. That has also no income profit gain element. Third is the issue of depository receipts on the back of permissible securities. That has also nothing like that. Next is conversion of security. All these past 3 activities are kind of, there is no change in the ownership. The beneficial ownership remains with the same person. Next is conversion of depository receipts into security, permissible securities. Here also we say that there should be no tax in case of a resident Indian. But in case of a non-resident Indian, supposing he is converting the BHDRs into securities and holding the securities then, he would have option to sell out these securities after some time. So he would buy a BHDR, hold it for a while till the price appreciates, and then he converts it into securities, foreign securities, and then sells. If he is taxed only for that last bit, he is escaping, his income is escaping from the tax net. So that is why we are saying when he is converting BHDR into security by a non-resident Indian, he will be subject to tax, capital gains tax, to the extent the difference between the BHDR price on that day and the BHDR price he has paid at the time of acquisition. Then there is conversion of conversion of the permissible securities into BHDRs. Again, there is no change of ownership, no tax element. Sale of securities, when after conversion, an Indian is selling the securities. He has not paid the tax when he converted, but now he is selling the securities. At that time, he will be subject to tax. So sale of securities, it is not taxable in the hands of non-resident Indian, but taxable in the hands of a resident. Then there is transactions in Bharata Depository receipts. It can be on exchange, off exchange, but we are limiting to listed securities. So we are suggesting that if the underlying is a equity, and equity in domestic environment enjoys or is subject to STT regime, then BHDR based on a equity permissible security should also be subject to STT regime. If it is a debt, it is subject to a different tax regime. Let that tax regime apply to transactions in BHDRs on debt. That means we are saying that BHDRs are Indian securities. The market for Indian securities are only in India, it's not elsewhere. So we give equivalence to BHDRs to domestic securities. So transactions in BHDRs in India will attract the same tax as if these are the, depending on the nature of the underlying permissible securities. Returns on Bharata Depository receipts will be treated. This is actually the foreign securities. Income is coming on foreign securities and is getting passed on to Indians. So it will be treated as if it is the income from foreign securities, from foreign permissible securities. And given the complication that the market may come up with the Bharata Depository receipts on a basket of securities, a mixture of debt, equity, all kinds of securities, we do not recommend as of now, at least to start with, any hybrid depository receipts. This is as regards BHDRs. As regards ADRs, American Depository Receipts, issue of securities, again, it's an Indian firm issuing the securities to a foreign depository. There is no tax, no transfer. But if there is a deposit of securities by Indian shareholders holding the securities, they are depositing with a foreign depository for issue of depository receipts. That will be taxed as if it is a domestic security. And in fact, we are encouraging that let a group of shareholders come up together, transfer those securities to a foreign depository through an organized process, through tendering process. And since this is something similar to transfer on exchanges, we are suggesting that let STT regime be applicable to that, but tax that as if it is a domestic security. Issue of DRs, conversions of DRs into securities, conversion of securities into DRs, these are one and same asset, no change in ownership, no taxation. But sale of securities, sale of permissible securities will be treated as if domestic securities. Transactions in Asia, in American Depository receipts are happening outside India, not taxable in India, and returns on permissible securities will be treated as if these are domestic securities. So based on the reasoning that some cases we are putting the securities at par with domestic securities, and some cases at par with foreign securities, and tax is arising only when there is a gain, profit or tax, not just for change of conversion from one firm to another firm without change in beneficial ownership. This is the taxation regime we have proposed. Thank you.
Thank you.
Sir, if I may add, Mr. Sahu was talking about the taxation approach in the document. Subsequently, the discussions that we've had internally in the Ministry of Finance with the Department of Revenue, the 3-4 major issues that we are in the process of discussing, not yet been finalized, are one, of course, is to expand the mandate of the present scheme to include in the definition of DRs all underlying securities, that is not just equities, but also debt and ETFs and others, but also to permit resident Indians from being able to purchase DRs abroad to the extent that the FEMA allows them to do that. One of the other major issues that we are talking to them about is this whole issue of unlisted companies being allowed to list abroad, where there are some issues which are being examined in the Companies Bill, in the new Companies Act, and DOR has raised the point as to whether that can be done without allowing any misuse to happen, and whether the number of shareholders in such companies needs to conform to 200 or more than 200. So that's another big subject of debate at the moment. And then, of course, is the issue of the parity of taxation for non-residents and residents, because there is the issue of fungibility, there is the issue of conversion, then there is the issue of residents also being allowed to hold DRs. So therefore, whether the same tax treatment for non-residents as is applicable for residents is to be extended. So these are some of the discussions that we are having, just to give you a flavor of the issues involved.
Hello. Hi, this is Gaurav Sood from ICICI Securities. My question is basically, like, we've seen a lot of these Chinese companies, when they go and list overseas, they mostly through depository receipts, despite the fact they've flipped their structure, they're incorporated in Cayman and all those kind of places. They still do, go and do DRs and do not list ordinary shares. Whereas we see, in India, like we saw Make My Trip, it listed ordinary shares on, New York on NASDAQ, and still got a 15, 20 times oversubscription. So basically, what is the way ahead for unlisted Indian corporates? Will it be through DRs? Because I understand if you list DRs on overseas, you have the way of coming back and listing back in their home territory. Whereas if you list ordinary shares, then you can't come back and list in your home territory. It becomes much more of a complex challenge. So what is your view on that?
Who is this question for? Whom do you?
It's for the Bank of New York team.
I'm happy to take it. You're absolutely right that in China, many companies have listed DRs on single-listed DRs in the United States. So companies that are largely from the technology, new energy sectors have conducted IPOs not in China, but in the US, and almost always use DRs like Alibaba as the instrument of choice. The reason why, I would say, is multi-layered. One of the key reasons is exactly the one that you've just given. Many of these companies in China certainly have a medium-term ambition to list back at home at some stage. They may not wish to or have the ability to do it today, but for political, cultural, and commercial reasons, they may wish to do it in future. And the convenience of the depository receipt, which is specifically designed, of course, to facilitate movement between two markets, really helps that process, whereas listing ordinary shares can actually make it very difficult. And there were some primary examples of that in China 10 years or so ago. But there are certainly other reasons why depository receipts might be a chosen route. I could probably talk for 20 minutes about why, but I think we would bore everybody in the audience. But I would put it down to one issue, and that's investor convenience. Investors certainly have voted with their feet often enough to demonstrate that they like the convenience of the DR route, whether the issuer is from China, India, Brazil, or Russia. And if you're about to embark on a very important corporate milestone like an IPO or an equity transaction, why risk going with the instrument that is unproven or not universally preferred? So companies have chosen depository receipts more often. And I would hope, particularly now with the liberalization that is expected around some of the regulations, that we'll start to see maybe not quite the volumes that we've seen in China in recent years, but we'll start to see a significant uptick in companies doing the same thing here in India.
Questions? Haven't heard anything from this side.
Thank you. My name is Ram Bhushan from Barclays. The question that I had was, did the committee discuss in terms of cross-border mergers? And when you have two corporates combining, there will be at least one jurisdiction which will have to either the local jurisdiction, which is India, or the foreign entity actually issuing DRs. I saw some recommendations which did talk about issuance for non-capital, non-fundraise activities. Does that envisage this kind of a situation? And two, in terms of taxation, when that's two companies merge and an issuance of DR happens, does it, would it be treated like similar to what a scheme of amalgamation with two companies merging and shares being issued?
If you could name the panelists, it will be easy for them
No,
to
we
decide.
do not, you don't have to name, we don't have answer to that. Our legal expert, I wish Mr. Somasakara Sundaresan was here. He had discussed this issue, but we are not able to figure out and give a clear answer to you.
Any more questions?
It's a question maybe to Christopher or Neil. Any volatility of the DR prices has affected the underlying prices of those shares traded in the local exchanges? Have you done any such studies? No, one of the panelists said that there is no systematic risk of this market. So if DR market is volatile and some heavy exposure is taken by investor over there, and to hedge that exposure, to uncover that position, they may take position in local market also. Such kind of trading pattern has been observed. What are your, based on your records or your findings or your research?
A great question. And if I heard correctly, the impact on price, obviously the impact of the home market on the DR price, but also vice versa at times. There have been studies for sure, and it really is related to the relative balance of liquidity. In my experience, it is quite a rare situation where the balance of liquidity is weighed significantly in the DR market. There are examples, but quite rare. And therefore, very often, the leading market in terms of setting the price would always be the home market. There are differences. I can think, for example, of many of the largest Russian companies that primarily trade on Ibercon's market in London, where the majority of the liquidity these days, for very specific historical reasons, is in London, in the DR, and we certainly see price, the influence of price moving in the opposite direction. But in most markets, it would be the other way. The one thing I would say is that I wouldn't be concerned about either way. I mean, it's very good for the stock and for the market to see this kind of fungibility and impact where it does happen. But for the types of situations that we're talking about today, where they are already listed companies in India, and establishing a secondary market facility where there is no, if you like, injection of instant liquidity into the DR market, I think it would be very, very unlikely to see the kind of flows where you would start to see significant pricing impacts coming back into India. Anything to add, Neil?
I thought Chris would take all the questions because he has the microphone. Just one thing to add there. I think often when you add another market, you can add another way to find price discovery. So actually adding another market could be beneficial, I think.
Just 1 second. I wanted to go back to the question, if you've finished the other one. The question from Barclays, was your question coming from the fact of the disclosure of ultimate beneficial ownership?
Not necessarily just the ultimate beneficial ownership, but just when two companies merge. Let's assume, take a simplistic example of a scheme of amalgamation between two companies. The issuance of shares would not result in any taxation. So in a situation where there is an outside shareholder, let's assume foreign shareholders a London company merging with an Indian company, and the Indian company eventually being the surviving entity. In such a situation, there might be certain funds with a mandate to invest only in developed markets, which would prefer to have depository receipts in London rather than invest in Indian stock exchanges. So the company issues DRs there. Is that permissible? Because today, as I understand, the IDRs envisage that there has to be a capital raise associated with it. On the reverse, assuming that an Indian company merges, now that the Companies Act has permitted or has taken away the restrictions of an Indian company being able to merge with an international company, and in lieu of the shares being tendered, Indian shareholders or Indian public shareholders were to get depository receipts listed in any of the global exchanges, what would be the consequences, and would that be permissible?
We'll have to come back to you. Let me go back and check this. If you want to give me your email ID later on, then I'll come back to you on this.
Sure, thank you.
So I have a question for the team from BNY Mellon. Where the concept of two-way fungibility, the way we understand in our program, is that two-way fungible only to the extent of initial amount of number of DRs issued underlying shares. So what comes back can go back and keep coming and going back. In your global experiences, when do you see this flow happening back into the ADR? Because out here, or GDR, out here I have studied all the companies, with the exception of very few cases in a few sequential quarters. We rarely see, once the shares getting converted and that limit being available, does go back. And the next part of the question is for Mr. Sahu and Mr. Kaushik, that did the committee think of that once you have a DR program existing, forget level 1 and other stuff that way, within that, remove this cap that the two-way fungibility is limited to only the amount of shares that were originally converted to DRs. So there's two: one, your global experience from Chinese companies; two, for Mr. Sahu to kind of throw some light on whether this was debated upon, and if permitted, it would change the dynamics of what you're trying to achieve in level 1 permission itself.
I'll try and take the non-Indian part of that question, because I think it's the easiest part. What experience do we have of kind of the practical effects of two-way fungibility? What are the flows like, backwards and forwards? I would say that in a completely open market that is free from restriction and regulation that might prevent or make it difficult for the shares to move, we actually see fairly free movement between the two markets. Remember here that we're talking about secondary market DR facilities, so there is no offering, and the issue that you talk about in India where there's an offering made of 10 million shares and the headroom or the restriction is at 10 million shares, and what is allowed is, as we see cancellations, you can see reissuance, and that hasn't happened very much. Neil will explain why that hasn't happened very much in a moment. But that's not what we're talking about here. We're talking here about purely secondary market facilities that start from zero. And what we've seen around the world in many, many markets is that, first of all, there is no flood into the DR program, first of all. It's a very gradual process. And once there is a critical mass, we will see over time, and in fact day by day, flows backwards and forwards. If you look at the balances of DRs in, again, open markets in the secondary market, you will actually see the balance changing every single day. And it's not moving in one direction, it's up and down, which is what the DR is perfectly designed for. It's about removing all of the friction that simply allows the movement of securities to where the demand is. Here in India, it's been slightly different, but we're hoping that that will change now with the new regulation.
Thanks, Chris. I think there are probably two markets that have a specific experience with GDRs to date and with smaller capital raisings. What you'll tend to find is if a company's raising 100 million by issuing GDRs, you will tend to find that those DRs will flow back to where the main pool of liquidity is. Now, bear in mind as well that these are restricted securities. They're issued under offshore from the US under Regulation S, to be slightly technical. I think, as Chris says, what we're discussing here is opening up to basically level 1 ADRs, which are in an unrestricted form. Now, just to comment on Chris's comment, for some of the more liquid GDRs from India on the London Stock Exchange, we see that ebb and flow back and forward every day. And that was a question that came up at our representation to the SAHU committee. Just one additional comment. I think India and Taiwan have had quite specific history around this type of issue. And just last week, the SFB in Taiwan came out with the announcement that they will also be allowing level 1 ADRs. So there's almost a race between India and Taiwan at the moment. And they used the SAHU committee's report in their analysis. So, yeah.
Any further questions? I have time for...
Can I just come into this? So I wish to say a couple of things to all of us, the Indian side of this room. So first is I think that the implementation of this report will require all of us to become more international in our orientation. Okay, as has been correctly emphasized, for the issuers, this is going to bring new pools of investors, and we need to rework our minds and start understanding that there are important pools of investment that are available for India, and we need to understand who these people are and establish more of an engagement strategy. For the financial firms in this room, we need to be thinking that there will be trading in our beloved Indian securities to a greater extent at locations all over the world. And that's part of life, that's business. So just like you are used to doing NSE, BSE arbitrage, you will be doing much more in terms of BSE and NYSE arbitrage and so on. That we need to understand that there is a changing structure of the global financial system, and we each of us have to serve that changing world. My third comment is about public policy. Sanjeev Kaushik correctly emphasized a very important element of the work at the Ministry of Finance. On one hand, you will see policymakers being very self-consciously callous, saying that whether the market chooses to trade in New York or Bombay is not our concern. Okay, this is competition, this is tough. It is exactly like trade liberalization in all other fields. Whether you buy Indian steel or Korean steel is not the problem of Indian policymakers. Indian steel companies have to learn to compete. Okay, so this is part one of the story, that the only reasonable platform for public policy is one to emphasize global competition, saying the consumers must get the best deal, that what is good for the people of India, what is good for the corporations of India is what is correct. And the financial services industry must compete, just as every other industry in India has had to compete. So just like we have opened up every other industry in India to global competition, the financial services industry should also be open to global competition. So this is part one of the stance of public policy. But equally important is part two of the stance of public policy, which is what he described as the Standing Council on the International Competitiveness of the Indian Financial System, which is about understanding and solving bottlenecks in competitiveness. Note, this is about making the Indian financial system more competitive. This is not about putting roadblocks against international economic integration. So if there are problems here, we should solve them. That doesn't mean we should ban imports. Okay, so if there are difficulties in how we do financial regulation in India, we should solve them. It doesn't mean we should intrude on the freedoms of Indian households and Indian firms by hampering their ability to participate in the ADR market. But this is an equally important plank of work for all of us here in this room, that we should be saying what is messed up about the way we work here and how can we fix it. And that is an equally important plank alongside the callousness. And that is exactly how trade liberalization has worked all over the world in every other field. That first and foremost, you have to get competitive pressure into the country. Okay? Indian steel companies started getting their act together when and only when it became clear that steel was going to be openly imported. Okay? That's part one of the story. And then part two of the story is we do need to remove the barriers to making a sensible Indian financial system. And I've talked about the Standing Council as a short-term part of the strategy for solving that. The long-term strategy is the Indian Financial Code, which will put the Indian financial system at a superior level.
So at the risk of stretching this a little, 5 minutes more, I know people want to go and do the Ganesh thing, but just to play devil's advocate, the world over, now there is an argument that everyone is looking inward and actually business is moving back in. here in India, we are actually talking now of sending our liquidity overseas. And this is a room full of people which would love to hear this, I think. So I just want to hear your repartee to that.
We're starting from zero, we are creeping up.
We talked about two limits. One limit is that the size of DRs cannot exceed 25% of the size of the permissible securities. So that limit we do not want to go up, because then it would happen that a tail wagging the dog. So that we do not want to do. The second limit we talked about, that the aggregate size of the DRs issued in as many tranches as possible, with the approval of the company, without the approval of the company. And we emphasize that the DR as well as the permissible securities are one and the same asset. So we do not bother whether these are continuing to exist in DR form or in the permissible securities form, as long as DRs do not exceed the 100% of the aggregate DRs issued till date.
Questions?
And Sanjeev's point that transporting, exporting, importing, liquidity, in fact, this has also disturbed the committee. Sometimes we feel that probably by ADR, we are exporting the capital market. One group of people feel that. We do not know how far that is valid. One argument could be that we ourselves here are not able to supply capital to that company, or that company is not meeting our requirements but meeting requirements elsewhere. But we do not want to give him an opportunity here, but we want to stop him from availing the opportunity there. But while ADR is considering about the export of capital market, we are also thinking, we told that we are living in a reciprocal world, we are also looking at import of capital market through IDRs. Occasionally we have the pressure of inflows. We want also to ease that pressure through outflows. So these are only the mirror mechanism of ADR and BSDR are two sides of the same coin. So if one is exporting something, the other is importing something. And it all would ultimately depend on the competitiveness of our financial markets. If our markets, our participants, our firms are mature, competent, then what is beneficial for us would happen.
The last question. Yeah, the front row.
I wanted to know, both from an international perspective from the Bank of New York team as well as from the SAU committee in terms of the intent, would it be only issuer-sponsored DRs which are permitted, or a dominant shareholder could pledge a part of his shares with a custodian and then issue DRs on that? Would it need to have the permission of the company or the issuer for a DR to take place?
Absolutely no. We are in any case not talking about hedging. We are talking about transferring actually. You are surrendering the shares with a depository. Depository becomes the legal owner. Thereafter, it issues the depository receipts. And by unsponsored, by definition, we mean that it has no role. The issuer has no role. Issuer will not be consulted. Issuer will have no approval requirement, but particularly for ADR, we have a caveat to this. The caveat is that supposing it is an unsponsored ADR. In that case, supposing Mr. X, who so far constituted a part of public shareholder, his holding counted for 25% of public holding. If he goes and surrenders these shares to a depository, then public float of the company reduces for no fault of the company. On the other side, it's possible that there is a promoter promoter knows that the company is not meeting the requirement of public holding, so it will go and surrender these shares to a depository if these surrender shares are considered as a part of public holding. To balance these two concerns, that company does not suffer while promoter does not take undue advantage, we have specified that our proposal is that if it is an unsponsored one in case of a listed company, then such unsponsored one is possible only if this is listed on an international stock exchange and DR holders have a right to give voting instructions. Subject to that obligation on the unsponsored, there is no obligation and the company has no role.
National perspective, how many DRs do you see between the sponsored and the unsponsored in terms, and what is the trend which you see? Do you see more sponsored DRs or it would be more towards the unsponsored DR?
I wish I had instant recall of statistics, but I can talk in generalities for sure. I would suggest it's probably about 50-50 actually, globally, between sponsored and unsponsored. There certainly has been quite a rapid increase in unsponsored DRs in the last few years for one very specific reason, and that is that the US SEC embarked upon, you might call a liberalization process of the regulations themselves. Very, very similar or echoing the comments that we've heard today on the panel, particularly from AJ Shah, around make it easy and let the market decide. The SEC decided in 2008 to try to make it as simple as possible for international investors for US investors to invest in international companies. And they felt that one of the hindrances to that was the need for international issuers to sponsor these programs, because there's a long corporate process that might be required and education and so on. And so they lifted many of the restrictions on unsponsored DRs, and we saw a rapid increase. Many hundreds of new unsponsored programs were established in the first few weeks and have continued to grow. I would look at it in terms of this. If you look at the major global indices around the world, whether it's the CAC Caron or the FTSE 100 or the Hang Seng in Hong Kong, what is the penetration of those indices by one form of DR or another, whether it's sponsored or unsponsored? In all of those markets where there is now a fairly liberal approach to these things, we see penetration of typically more than 90% on all of those. And that is what I would, of different sizes. I'm not suggesting that all of these programs see great activity, because that is driven by the market. But where there is a facility available for an investor to invest in a DR if he wishes to, it's above 90% or so.
Thank you. Then probably if you have any more questions, you can ask the panelists during the high tea and networking time, which will follow the vote of thanks. Before that, before I move into the vote of thanks, we have a small memento presentation ceremony. Ashish, MD and CEO of BSE Limited, wants to give away some mementos to the panelists. Last couple of minutes before we break for high tea and networking. Well, I thought I'd do a 5-slide presentation on vote of thanks, but someone stopped me from doing that, saying that you will be the first person ever to do a slide presentation on vote of thanks, so I shied away. Anyway, on behalf of BNY Mellon, BSE Limited, and Pivot, and all our associates here, and on my own personal behalf, I should like to thank all the speakers on the dais who have presented or shared their opinions and findings with us, more importantly on the new SAO committee report. I must also thank for each of you who are in the audience for responding so well at such a short notice to be here amidst us this evening, which reflects two things from your side. One is your dedication towards understanding the latest developments in the market. Second, your own company's interest in doing so. Ladies and gentlemen, an event like this cannot happen overnight. The wheels started rolling a couple of weeks ago, and I think I must say a big, big thanks to Ashish's team, who are very dedicated and motivated and helped us in putting this event together. A big thanks to Kalpit and his team and whoever is behind this job. We are very grateful to Ashish Chavan for his wonderful opening comments and as well as his guidance in putting this event together this evening. And I'm sure this is as successful as all of us wanted this to be. I must mention a deep sense of appreciation and with respect to Mr. Sahu, who has been the author of his wonderful report, which I personally believe is a path-breaking review of DRs, which I'm sure and confident that it will infuse a lot of foreign investment into the country. Ladies and gentlemen, you should give a hand to this gentleman. I would also like to acknowledge with gratitude the eminent professor, Mr. Ajay Shah. Every time I've spoken to him in the last 3-4 days, I've been mightily thrilled with the kind of knowledge he possesses. You would have heard his responses to some of the questions, and for letting us know how this report came into being, and also the changing landscape of regulatory and risk standards within the country, which I'm sure will only go on the upward curve as the macroeconomic fundamentals improve and India seek more and more foreign investment into India. Thank you, sir, for that. I'd also like to express my thanks to the colleague just left, Sanjeev Kaushik, who gave an excellent account of what the government is proposing and how the government is thinking in changing the whole capital market governance and the products that are coming into being. I must also thank Mr. Chris Kearns and Neil Atkins for the respective views on the international market and also the DR markets in India. Finally, I must also thank our friend on my immediate left, Viraj, who has been instrumental in guiding us and also giving us few ideas and tips on how to go about conducting this event. So we're all grateful to you. For the audience, who have been good, some brilliant questions. I'm sure you will have far more questions. I'm pretty sure that some of us shy away from asking questions in such a large gathering. You can ask those questions while we are at the tea. So we're all inspired by the most of the opinions and the great words spoken by the panelists. And thank you once again for being here with us. I'm sure it was a pleasure. We have the pleasure of having you here, and we are very, very grateful to you once again. Thank you very much.